To an outsider, the stock market looks like an exclusive club for math geniuses, or a giant, chaotic casino. We see shouting traders, flashing screens, and Wall Street jargon that makes investing feel indistinguishable from high-stakes gambling. But to understand how wealth is built, we have to unplug those screens. We need to ignore the squiggly lines and red arrows and look at the foundation of commerce. Behind every three-letter ticker symbol flashing on a screen sits a tangible, real-world business selling physical products or services to real people. Imagine a local lemonade stand that makes a healthy profit every summer. The owner wants to open 10 more stands across town, but doing that costs $1,000, and a massive bank loan carries too much risk. Instead of borrowing, the owner cuts the business's total value into a grid of equal slices, selling a few to outside investors. That individual slice is a stock. By purchasing it, you legally become a shareholder, a part owner of the entire operation. When a company performs this sale for the very first time to raise money from the public, it's called an initial public offering, or IPO. It serves as the grand opening of the business to outside owners. This transaction trades your cash today for a legal percentage of that exact company's future profits. Most beginners misunderstand where their money goes. When you tap Buy on your phone to get shares of Apple today, your cash does not go to Apple. The company received its funding years ago during its IPO. Instead, you are buying those shares from another investor who decided to sell them. The stock exchange functions as a secondary market. It acts as a giant digital shopping mall connecting millions of strangers trading used slices of companies. Because shares are limited, stock prices fluctuate every second based on supply and demand. If more people buy than sell, the price rises. Market demand is forward-looking. Investors set prices based on expectations of what the company will earn years from now. The stock market acts as the middleman. All that wild second-to-second volatility you see on a chart is the real-time measurement of human optimism and fear. If you own a tiny slice of a massive company, the investment puts physical cash back into your pocket through two distinct mechanical engines. The first is capital gains. If a company builds new factories, hires better engineers, and sells more cars, the business becomes more successful. Demand for its shares rises, allowing you to sell your slice to someone else for a higher price than you paid. The second engine is dividends. Some massive, established businesses already dominate their industries and generate mountains of excess cash. Instead of building unneeded factories, they deposit a cut of those raw profits directly into shareholder accounts every few months. Younger, fast-growing tech companies often skip dividends to reinvest every penny back into their own growth. In contrast, mature companies use dividends to provide investors with steady, passive income. Whether the stock price appreciates or you collect quarterly cash, these returns provide the financial reward for bearing the risk of ownership. Because prices swing based on inflation, interest rates, and global panic, investors often fall back into treating the market like a casino. They buy into a company because it's trending on social media. They try to time the daily swings of the market, and the moment their screen turns red, they panic and sell their shares at a loss out of pure fear. The highest risk comes from putting all your capital into a single company. If you own just one stock and that specific business faces a lawsuit or goes bankrupt, your entire investment evaporates. If you approach the stock market with the impatience of a gambler seeking a quick thrill, the market will take your money exactly like a casino would. The antidote to individual stock risk is an index fund. An index fund allows you to buy a single basket that holds tiny pieces of the 500 largest companies in America, all at the same time. This spreads your risk out completely. If one company fails, the impact on your wallet remains minimal. As long as the broader economy grows and innovates over the decades, your wealth grows along with it. Handling this effectively requires a simple strategy: dollar cost averaging. You automatically invest a set amount of money every single month, regardless of the news. When the market is down and prices are low, your $100 buys more shares. When the market is high, it buys fewer. This smooths out the roller coaster. You stop trying to time the market, because historical data shows that time in the market builds wealth. Success in the market does not require checking charts every day. True financial growth comes from the consistent, patient ownership of the most successful businesses on Earth.